All right, go ahead.
We're a half hour away,
It's
Dave.
Friday, we're almost there.
From the open in Hong Kong, Shenzhen, and Shanghai. You are watching The China Show. I'm Stephen Engle with my partner here, David English.
It is the Engel and English show today. The stocks across the region getting a tailwind out of Wall Street. President Trump says he will push for lower interest rates and cheaper oil. Global equities are nearing record highs.
And the Bank of Japan, it is BOJ Day, Dave, set to announce its policy decision today with a jump in the key inflation gauge to 3%, supporting the case for a rate hike. It's pretty much baked in, isn't it?
Yeah, that should be coming in the next 2-3 hours or so. Plus, we'll be taking a look at Hong Kong's New World development. Well, the company says it will speed up its residential sales in Hong Kong as financial stress continues to worsen. We look at the potential fallout on the city's lenders. Happy Friday morning from the Asia Pacific. Yes, we are almost there. We have a couple of other major things to get through, of course, as we approach the weekends, notwithstanding, of course, the BOJ decision, which should be out in about 90 minutes or 2 hours from now. Baked is priced in. Certainly the inflation print, which came out about 90 minutes back, in many ways has cemented already consensus at this point in time. Headline CPI coming in at the very top end of forecast, 2-year high on the headline number, 3 handle, of course, on the core gauge as well. All that being said, of course, the tailwinds coming through for risk assets, right? So every single day this week, we've seen gains on the regional benchmark. Of course, we have a full trading left. Watch that for that very, very closely. 2- and 10-year yield on your screens right now. We did get a mixed picture, of course, on the Treasury curve overnight, although as you can see in the Asia Pacific, it's fairly consistent with yields, generally speaking, on the way up. Currently, dollar-yen is going to be an interesting trade today because of how crowded some of the positioning has been. So even if we do get an interest rate hike out of the BOJ today, there are calls out there, expectations that the yen might actually weaken, given how it will depend, of course, on what they say and what those forecasts actually look like. The other thing we want to tell you about is Singapore is just coming online as well, and also a rate decision there, monetary policy decision. So on the 2 of the 3 metrics of the MAS, they did adjust the slope. So it's one of those things that we pretend to understand how they conduct monetary policy. I honestly do not, but I'm just here to read the headlines for you guys. In any case, the ease policy is the effective way of saying that. Right, A50 futures going into the session today, and we are on track, by the way, for a weekly gain in Hong Kong. We're poised for a flat session in the onshore markets. We are awaiting the Bloomberg China Economic Survey, the latest of which should be out at some point this morning. The thinking around really this economy and how it does this year. Although that being said, there are lots of wild cards out there, including, of course, tariffs and how that actually impacts the outlook here as well. Among many other things, Steve, we'll be tracking here.
A lot. Of course, at the MAS in Singapore, they have the currency band and they have the slope, and they basically eased it for the first time since 2020 after 5 tightening measures. All right. Coming up today, it's a busy day. One of the top stories on top worldwide on your Bloomberg terminal is the New World development, and the bonds continue to be suffering from this crisis of confidence at the Hong Kong developer, which has a lot of exposure, obviously, in China. Its debt restructuring concerns also plummeting bond prices. Its stock price also down to 2003 levels. Basically, they've changed their CEO twice in the last couple of months. So it's a tough situation for New World Development and the Cheung family there. Hang Lung earnings will get another pulse check, essentially, of the health of Hong Kong developers. Their debt-to-equity ratio not nearly as bad, obviously, as New World Development, but still we'll have to see whether there is some confidence from some of these Hong Kong mid-tier developers like Hang Lung. Sunak and Tianqi Lithium in focus today, among others, obviously. Sunak brings in a new investor to restructure its Chongqing Bay project. We'll talk about that a little bit later on. And Tianqi Lithium, profit warning of $1.1 billion US, Dave, for 2024, and they are halting expansion of an Australian project. I've gone on too long on the agenda. It's a big day.
I mean, there's a big day, lots of stocks to watch. And I think on the Tianqi Lithium, just to add to that, too, there's an impairment that they've also come out with as well. So we're looking at that. CK Infrastructure is also out on some of this report, in case you missed that as well. They're looking they're said to be mulling the sale of one of their assets in the UK. So again, lots of idiosyncratic stories to track as we wrap things up here for the week. I'll set my papers here aside. How busy the day is today. Yeah. There we go. Let's get to your top story. Donald Trump in Switzerland, in Davos, has told global business and political leaders gathered there that he anticipates a very good relationship with China, but says it must be a fair one. Let's bring in Jill Deesis, our news desk editor, to take us through. Let's start with his comments on China.
Yeah, I think at this point, what we've really seen out of Trump, not just during this Davos speech, but really just over the past week as he's kind of taken office, is a much different approach to China than I think a lot of people were initially anticipating. Heading into his first day in office, there was some thought about whether or not he would want to impose day one tariffs on China. We've since seen him kind of push that off a bit and say maybe 10% tariffs down the line. February 1st might be that target date. So, not letting up the heat entirely, but certainly I think just kind of, taking a more pragmatic approach than some people thought. You're seeing that kind of continue with some of these, remarks during Davos, kind of casting the relationship with China is one that could potentially be a very good one. He's actually seems to be kind of leaning on China and Xi Jinping a little bit to kind of help negotiate an end to the war in Ukraine, really kind of casting more of a focus on that being the onus being on Vladimir Putin rather than on Zelensky in Ukraine, which I thought is kind of an interesting approach, kind of indicates Trump really, really wanting to focus on that idea of more deal making. But yes, I mean, back to China, I mean, you combine all of these comments with the fact that, he seems to want to make a deal to keep TikTok operational in the United States, and at least at the very beginning of his term in office, does seem to be taking a little bit more of a nuanced approach to China than he did maybe during his first term.
There was a lot to cover. Again, we have a lot to chew on from Donald Trump over the last 3 days, obviously. And in this speech to Davos, he talked about the need to bring down interest rates, but also bring down oil prices. And he linked that to expediting the end of the war in Ukraine.
Yes, he did, Steve. So ultimately, he's kind of calling on OPEC nations to essentially, increase production, bring down the cost of oil. He's saying that would, in addition, obviously, to some more recent sanctions that have gone into effect, kind of put more pressure on Russia to help end the war in Ukraine. So again, kind of goes back to that idea of, this combination of putting that pressure on OPEC nations to help here, plus, putting that onus on Vladimir Putin to help end this war. Obviously, ending the war in Ukraine was one of, Donald Trump's big campaign promises. He said he wanted to essentially end it on day one. So you see him kind of going in pretty hard on that. Of course, the big caveat to all of this is that, it's very difficult for these OPEC nations, Saudi Arabia, most included, to, immediately try to bring down the cost of oil, immediately try to increase production. We've seen more of, them wanting to kind of make a very steady approach to some of those production issues over the, past several years. The Saudis have to really balance their budget. There's a lot here that creates some obstacles, but, obviously, Trump with his very sort of bombastic, let's make a deal approach, I think he's kind of having none of that.
Even the Fed wasn't spared.
Yeah. No, and which doesn't really, I think, surprise us at all at this point, right? I mean, I think that Donald Trump certainly during the speech is kind of saying that we need to sort of bring those down, those rates down immediately. I mean, look, Donald Trump, I think, over not just the past campaign, but also even during his first term in office, has made it, very clear that he's willing to kind of go after Powell, who, remember, he picked as, Fed chair, and, really kind of go in, I think, a lot harder than a lot of, U.S. presidents traditionally have. Usually, historically, at least, you see U.S. presidents kind of, let the Fed chair kind of do their thing. But I think that, Donald Trump has really made no secret that he's completely okay with kind of needling the Fed and Jerome Powell over some of these issues. We saw that certainly at play, here during his speech in Davos, and would not surprise me to kind of continue to see Donald Trump sort of make those direct overtures to Powell and the Fed going forward.
All right, Jill, thanks so much. Bloomberg News desk editor Jill Deesis there. Let's bring in Francis Cheung, head of FX and rate strategy at OCBC Bank. Do we have Francis?
Yeah, I think Francis is there.
Is she there?
Or we're about to find out live on air. It's Friday. There we go. Francis, hi. Happy Friday to you. Do you hear us clearly, just to get that out of the way?
Yes. Please go ahead. Yeah.
What's up? Okay, go ahead, Steve.
All right, a little bit of a delay there. Apologies. All right, well, let's begin. Obviously, it's rates day in this part of the world. Obviously, we have the BOJ. We also had the slight easing of the slope by the MAS in Singapore. How would you say what's happening in Asia Pacific is perhaps in reaction as well to what's happening in U.S. policy with the incoming Trump administration?
Yeah, so in terms of the inauguration, at least the worst case scenario did not happen or has not happened yet. So the hope for potential incremental approach in terms of tariff policy did give market a little bit of a relief. So in this part of the world within the region, we can see that a lot of the Asian central banks are going forward with their monetary policy primarily based on their domestic economic fundamentals, right? Unless there is any financial turmoil or more dramatic headlines coming out from the U.S. So previously, we have the Bank Indonesia easing, which is a very good case in point. And this morning, we have MAS also reducing the slope of the so-called Sing dollar near. So the policy is slightly different in Singapore because they don't have an interest rate policy. Instead, it is an FX policy, but nevertheless, there might have some implication on interest rates. And most of the central banks in the region would be on an easing path, except you just mentioned about the BOJ this morning. We have a very long-held view that the BOJ should continue with additional interest rate hikes. However, now that the market consensus is also for almost a 25 BP hike being in the price for this morning, so where do we go from here? Given that it is already in the price, so I guess unless the Bank of Japan would sound hawkish together with delivering an interest rate hike, initial reaction probably would be quite muted for yen swaps. But that is only for the very near term. Looking further ahead, we are actually penciling in a total of 3 hikes from the Bank of Japan, including the expected one this morning. So we are looking for a gradual drift higher in yen interest rates. So that might be in contrast to some other central banks and even in contrast to the U.S. Working quite favorably in terms of interest rate differentials for the yen itself.
Francis, David here. Then, if I could just follow up there with the BOJ, it seems like your projected terminal rate is at about 1% for the BOJ. A lot of people are looking at the guidance coming through out of the BOJ today. What do you think will stop them from giving that guidance that they can, in fact, get to 1%?
Yeah, I guess actually they would be quite reluctant to be committed to interest rate hike path, just as many other central banks are also saying that it is all data dependent. That's why we think that the risk now, given how the market has been set up, would be for a somewhat dovish or just neutral BOJ interest rate hike. Of course, they can talk a lot about the virtuous cycle between wage growth and inflation, but that is nothing new. If you read all their research papers, deep down, we do believe that they would like to continue with interest rate hike. However, at this juncture, because it's kind of a one step at a point, that kind of mentality, so unlikely that they would give a very strong hawkish signal. So that is where the shortfall may come from. However, again, that is only the very initial reaction. Over time, I think the BOJ governor has already previously said that 0.5% or 1% is not really the very strict bar for them to overcome.
Francis, how much of a risk is there that the yen slides on this rate hike, whether it's because Ueda-san is too dovish or it's just already baked in, the hike is already baked in?
Yeah, precisely because it's already in the price, at least for this meeting. And if weather sound dovish, then that could also mean that any downward move in dollar yen would be a bit more constrained. However, in terms of the yen, right, it is a bilateral exchange rate. And of course, we have another very big important factor on the equation, which is US dollar rates. And US dollar rates probably would be more prominent because the movement is bigger than the yen rate itself. For yen, we also would expect any upside to JGB yields to be a little bit more limited in the near term. 10-year, we are still looking at the next level, very near at 1.25%. So what would be the driving force for dollar yen is still we have to go back to US dollar rates. And on US dollar rates, we actually have a little bit more a sanguine outlook than market consensus. And our Fed rate call is also a little bit on the dovish side. However, as mentioned at the start, right, this kind of market relief is unlikely to be extended into outright bullishness for the bond market at this juncture because of a lot of uncertainty there, especially uncertainty about the inflation impact of Trump's tariffs.
Right. Francis, the dollar has been, I'm almost reluctant to use present tense, at least past tense, was on slightly weaker footing earlier in the week. Do you think that's a temporary softness in what's otherwise still a stronger dollar, or do you think the softness can continue here in the greenback?
Yeah, if you're talking about medium-term perspective over the next few months, we do see chance that the dollar would soften a bit. But again, this kind of move is not a one-way train. The issue at this juncture is that investors still very reluctant to add to Fed fund rate cut expectation, right? So the mentality is that the investor might want to wait for the next Fed fund rate hike to materialize before they add to rate cut expectations. However, our base case is a bit more dovish. We are expecting 2 to even up to 3 interest rate cuts from the Fed itself. So over time, if that kind of scenario pan out, that would add to a little bit of the dollar softness. But in the interim, because the market still continue to brace for all these tariff headlines, right? It's not coming yet. It's just a delay, but mostly would still come in some form of or the other. So that would still keep dollar rates a little bit attractive for now.
Hey, Francis, we're a little bit about a month away from the National People's Congress in Beijing, where we're likely to get policy stimulus. Fiscal is what everybody's watching for. But where can China use their monetary tools, and do you expect them to help them boost that growth?
Yeah, I think they would be deploying a combination of monetary policy and fiscal policy, but fiscal policy would be more important given the focus in reviving domestic consumption. But monetary policy could be complementary. At least they would be there to try to support liquidity. And recently, when the onshore liquidity in China got tighter, and shortly after that, at least PBOC did come in, right, to inject some 7 days liquidity. However, when we look at their operations, it seems that the support is also not massive because they might see monetary policy as not as effective in supporting growth at this juncture. So overall, the market would still be hoping for a combination of fiscal and monetary policy. In terms of fiscal, then that would mean that they would be increasing bond supply. And through that channel, we might be looking for a bottoming out in long-end China interest rates. However, at the front end, if there is still some potential room for them to do some outright monetary easing, then the front-end renminbi rates might be a bit better anchored. So after the recent flattening in the CGB curve, we would be looking for the curve to be steepened somewhat.
Francis, thank you so much. Have a great weekend ahead. Francis Cheung, Head of FX and Rate Strategy there at OCBC Bank. Counting down to the open, the final session of the week, just over 11 minutes away. This is the China Show. Welcome back. You're watching The China Show. This new report out of Morgan Stanley highlights really the only game in town as it pertains to this relationship. Tariffs, and tariffs. Robin Xing is here with us on set. Their chief China economist, of course, to underscore what your baseline is. Let's start there. What is your base case scenario?
Well, tariff risks are here to stay. We have a gradual but steadily increase of tariff from today's 10% on everything to 15% by mid of this year, 20%, 26% by end of this year, and probably to 36% by end of 2026. So that's gradual and steady increase of tariff.
Now, Robin, I want to drill down into something that you highlighted in your report, and it's not something we've talked about a lot, but it impacts a lot of shipments from China to the United States, and that's that duty-free de minimis exemption for packages of $800 or less. Now, everyone says, why do I care about this $800 or less? Well, there's been about 1 billion different parcels going from China to the United States that Customs and Treasury can't simply account for, and they want to close that loophole. What kind of impact is that going to have on top of the tariffs on Chinese e-commerce and overall shipments to the United States of products?
Stephen, that's a good point. Many investors probably overlooked that. In fact, some people thought that Trump may have been going easy on China. But on day one, he asked the administration to review 3 things. One of that is this small-scale exports exemption of $800. A lot of e-commerce platforms are using that to do cross-border exports to the United States. If that part, after April 1st, with the new memo from U.S. administration, they charge some tariff, it's going to have some disruption to e-commerce platform.
It's also considered a national security threat, because they feel that some products that they can't secure or can't open up and don't necessarily know what's coming in, whether it's fentanyl precursors or other illicit goods. So that's a closing of that loophole is something the Biden administration looked at as well.
Well, I think it's clear that the pathway for de-escalation trade tariffs will be very, very narrow. You mentioned one of the concerns, national security. Take other things like export control. The high-tech exports from U.S. to China, that's off the table. So some investors are asking, is there any chance of a grand bargaining deal, like China, U.S. going back to phase 1 deal? Because that's one of these things Trump administration is reviewing now.
Right.
And it's expected to be ready by April. But if you look at phase 1 deal, it was too ambitious. China committed to purchase an extra $200 billion from the U.S. from 2020 to 21, and it fell short. They reached about 60%. Can they re-deliver that today? 6 years after phase 1 deal, a lot of things changed. The national security concern, the export control, and high-tech export from U.S. to China, that's completely off the table. So I think the bar will be very high for them to reach some kind of a de-escalation deal.
Right. And supply chains have also rejigged, because if there was a pandemic, by the way, in between the phase 1 deal and right now. Robin Cheung will be rejoining us later on to talk us through the implications and more, of course, from this fantastic report out of Morgan Stanley. Futures and your pre-markets are looking like this. We are on track for a weekly gain here in Hong Kong. 5 minutes away, the opening bell. This is the China Show. Right, welcome back. The approach to the open is we're pointing higher, and we are set to open higher. We're set for a weekly gain in Hong Kong. We could actually eke out one onshore. Globally, equities have done extremely well this week on the back of this rally in the U.S. We are close to a record high on the global gauge. The open is next. This is Bloomberg. Good morning. Welcome back. You're watching the China Show. You're just in time as we have a couple of seconds ahead of the open. It's a breaking news right now. We were largely expecting this next few days or so. But since it falls on the weekend, it did come out today. The 1-year medium-term lending facility is out, unchanged on the rate. Is a net withdrawal of just under 800 billion renminbi. So effectively, the headline is they've conducted 200 billion of 1-year MLF, and you do the net, what you have is effectively a withdrawal of 795 billion as far as that is concerned. Okay, the approach to the open today, and it's worth pointing out, of course, it's Friday, and you know it's almost a universe ago that we had this live briefing yesterday. I almost forgot about that, and certainly when you look at markets, they've more or less forgotten about that. Massive pop at the open yesterday.
But it petered out.
It petered out into the close, as you point out. And as you can see, the momentum has certainly continued to the downside right now. About 0.25%. We do have a two bond auctions today. I think we have a 2-year and we have a 5-year bond auction today. About 230 billion renminbi is being auctioned out, so just watch for that very closely. The open in Hong Kong is looking like this. We are doing slightly better. If I could just cheat my screens here. Yeah, there we go. 0.5% to the upside. We are on track for a second week of gains here in Hong Kong. Okay, we have a lot of stocks to get through, in fact, so please bear with me as I just sort of rummage through my notes here. Okay, CK Infrastructure down 0.4 to 1%. The story here is that the company is said to be mulling weighing the sale of one of its assets in the UK, Rail, rather. Okay, flip the boards, please. Next one to watch. Oh, this is a big story. New World Development is up in the equity market. Some of your bonds are trading right now, and the fact that we're at 40 cents tells you everything you need to know about the sentiment around this company right now. The company's out with a statement. Sales actually in mainland China topping their estimates in the 6-month window to December. They're also talking about guidance and the revenue pipeline for Hong Kong, and they're looking to hasten that. Go ahead, Steve.
We need to break that down on whether that is an aberration, because they're saying that they're getting already 70% of their annual target in just the first 6 months, China's sales numbers. Probably not by value, maybe by units, but we'll have to see whether, because that would be very good in a very troubled Chinese market if you're getting already 70% of your perhaps already lowered target just in the 6 months.
Yeah, that's a key context there. What are they doing right? I think it's certainly a question.
Or is it a fire sale?
We don't know. In fact, you know what? For our Bloomberg clients, we do have actually a deep dive coming up on this. In fact, it's already on the terminal for you. We've dissected what it means for the company and also the exposure of Hong Kong banks to this story, and more on that in the next hour of the show. Tianqi Lithium, profit warning out of the company. It's halting some of its expansion plans, and it's out with some guidance on its impairment too. So shares are down, A&H shares. And Bungang Steel is actually one that we're tracking, and this one actually just making the headlines just a few minutes ago. Reason why we're looking at this is President Xi Jinping, according to CCTV, visited the company in Liaoning on Thursday, up 3.4%. There we go, on the stock.
It's a steel-making region. I lived up in Liaoning province.
Oh, yes.
35 years ago.
This is very old school. Tell us more stories, Steve.
No, let's get back to Robin Xing. He has the insight that we really want to hear, Chief China Economist at Morgan Stanley. So we talked a lot about tariffs, and we can maybe expand that conversation to how it relates to the policy response in China. What is needed? There's been some stabilization, there's been some policy, but there's been promise fatigue as well. What is needed to get this policy working for the Chinese economy? Or does it actually, in your report, you say authorities might think they've done enough to stabilize the economy that they won't get the big bang stimulus? What's your assessment?
It's a complex picture, but let's break it down to 3 things: tariff, deflation, and the undershooting policy stimulus. On tariff, our base case is a gradual but steady increase of U.S. tariff. And that's already happening, affecting Chinese economy. Why? Because every single firm is trying to front-load their shipment to the U.S. as much as possible, as fast as possible. That contributed to this fourth quarter GDP, which came at a beat.
And exports, perhaps an aberration in December. They were up more than expected,
exactly.
10%.
So out of this 5.4% official GDP number in fourth quarter, half of that, 2.6 percentage point, was contributed by net exports. That's the contribution from front-loading of exports due to tariff risks. So you can see once tariff is here, say, from second quarter onwards, then you will see payback from that front-loading. That's why our base case for the Chinese growth will be nominal GDP will be probably hovering around below 4% from second quarter onwards once that payback from front-loading is there. So it's still a deflation problem.
Yeah.
And the policy reaction you mentioned, I would say they are trying. There are some small steps has been taking place. And in the National People's Congress, they will announce more measures. But it's not enough to reflate the economy.
Will they undershoot at NPC, though?
We are talking about 2 trillion yuan. 2 trillion yuan expansion of this augmented fiscal deficit. So that's smaller than 1.5% of GDP. So it's a very modest package. And a lot of it is still about investment. That's the problem of China's deflation. Too much investment, too much capacity. And the boost on the consumption side is still insufficient. That's why I don't think this MPC stimulus package will be enough to decisively reflate its economy.
That's the old cocktail, Dave.
I mean, it really is. And I think this goes into my next question. And someone asked me this recently, and it was actually a very good question. If China is hitting its growth target, why does it need all this stimulus?
Well, the target was hit partially because of the front loading of exports. Right. Back in fourth quarter, half of that 5.4% was contributed by net exports. That's not sustainable with the payback. Once tariff will be here, it's going to affect the exports, supply chain, and some corporate confidence. By the way, all this investment-driven growth, like manufacturing capex, is also creating problem for headline pricing indicators because there are too much capacity. So you can see firms cannot sell their product at a better pricing. That's why nominal GDP matters more than real GDP. Real GDP is volume, but because GDP deflated is in persistent deflation, now nominal is roughly around 4% or even weaker. Firms cannot sell their services or product at a better pricing. That's a problem.
I was going to bring up the GDP deflator because it really does show you the impact of deflation on this economy. I mean, a lot of people like to make that simple comparison to Japan's lost decades. But is this a harbinger to a similar kind of situation in China where they cannot stimulate their way out of the deflationary spiral?
Well, I think one thing they can learn from Japan is shift the policy from a supply-centric mentality to consumption. Japan gradually is reviving now, but that's after so many years, and they learned, and they tried, they keep trying. China today is in year 4, the 4th year of this housing downfall. I think if they learned, maybe it won't take them like a decade to find the right dope of policy. But this is 2025, year 4. I think they are still in the year of trying. Maybe it's not enough. It's not working yet. They will try again until the social dynamics, the feedback from public sentiment and the perception of social instability will force them to react more decisively.
Are you seeing any green shoots in the housing market?
I mean, transaction volume in Tier 1 cities stabilized a bit, but if you look at nationwide, because of the inventory overhang in most cities, nationwide investment and sales is going to decline by 10% this year by our estimates. So it's still a very weak housing market. That housing adjustment hangover is still affecting Chinese economy. It's still a drag to economic growth.
Can the Lunar New Year holiday that's coming up be a good springboard for consumption? Or is it going to be like last year, where it was a blip upwards and then it petered out?
Well, they are definitely doing a little bit more on consumer stimulus. This cash for clunkers subsidy has been extended. Now people can buy phones, tablets, not just the cars or TVs. So that helped some sectors. But if you look at the size, maybe 300 billion, 400 billion RMB. And China today is a 135 trillion economy. So that package is just too small.
Yeah. I want to round up the conversation with tariffs. We started with that. That seems to be the big issue here. And certainly the uncertainty over the timing and the magnitude is almost worse than the future outcome. And I'm wondering, does China have the capacity to do something to avoid tariffs? Are there concessions they can be made inside trade or outside trade, for example? Is there a scenario with which they can avoid?
Well, that's the number one question everybody has been asking. Looks like on day one of the U.S. new administration, they didn't emphasize too much on the Chinese tariff. So the market was talking about maybe they can go back to have a trade deal or a grand bargaining deal. But we took a deeper dive on the phase 1 deal. It was very ambitious, but it fell short.
But then the pandemic happened.
Yes, there's a lot of factors, disruption from COVID, but it was just too ambitious. The targets were too high. An extra $200 billion purchase in 2 years. If you look at it today, that's even harder for China to do that because supply chain changed over the last 6 years. some ways it's a good thing, but it's both a curse and a blessing. Chinese companies becoming more and more competitive. That means out of these 97 sectors, China gained more market share, more trade surplus in 57 sectors over the last 6 years. And they don't need to import that from US. Yeah, there are still some high-tech things US can export, but that's off the table due to national security concern.
Yeah.
So the difficulty of reaching some de-escalation just based on how much they can do on trade side is very, very
Vice Premier saying they're going to buy more. They can buy more, but we'll see. Right. Robin Xing, Chief China Economist at Morgan Stanley. Always good to have you here in the studio. Plenty more ahead. This is the China Show, and this is, of course, Bloomberg. Well, here are some of the global stories we are following. China has rebuked U.S. Secretary of State Marco Rubio over his comments on the South China Sea. In one of his first statements since taking office, Rubio criticized what he called China's dangerous and destabilizing actions in the disputed waterway. That's prompted the foreign ministry in Beijing to say the U.S. has no right to interfere. And ByteDance says it's exploring options to keep TikTok running in the U.S. without selling its operations. ByteDance board member and General Atlantic CEO Bill Ford telling Bloomberg he's optimistic about finding a solution, citing a constructive environment and a rich pipeline of deals in the sector. TikTok's parent company has been given 75 days to come up with a solution after President Trump signed an executive order extending the deadline for a sale.
I think there's a number of alternatives that we can talk to President Trump and his team about that are short of selling the company, that actually would allow the company to continue to operate, maybe with a change of control of some kind, but short of having to sell. I'm optimistic about the dialogue that's emerging between President Trump and President Xi, and that might help create a much more constructive environment, a much higher level of engagement that could lead to a positive solution.
Meanwhile, President Trump has signed executive actions focused on cryptocurrency and AI. The crypto order creates a working group to advise the White House on digital asset policies. But some crypto bulls were left disappointed that it didn't specify Bitcoin as the center of a national reserve. Trump was joined by White House advisor David Sachs, who says the AI action will allow the U.S. to lead the world in the sector.
Okay. Let's stay on the Davos theme here. So back in 2017, seems like, again, a universe ago, weeks after Donald Trump's first election victory, President Xi Jinping became the first Chinese president or head of state to address WEF. Now, this time around, it's a different story. Bloomberg's Asia government and politics correspondent and our co-anchor, of course, here on the China Show, Rebecca Cheung-Wilkins, filed this report.
Davos isn't exactly known for being an understated gathering of policymakers and business people, but this year there is one country that seems to be playing or keeping a somewhat lower profile, and that's China. Now, take, for example, the senior official that it sent this year to speak. That was Vice Premier Ding Shuixiang. Compare that back to 2017 when we saw President Xi Jinping become the first Chinese head of state to come and address the audience here in Davos. And even just walking down the promenade on day one, all the companies were sort of out displaying their banners and logos. But one of the only Chinese companies, TikTok, of course, ensnared at the heart of so much controversy, actually was almost invisible because it had a big white awning out in front. Now, you know, there could be all sorts of reasons why that is, but symbolically, that sort of seemed to resonate with some of the delegates and executives that I've been speaking with this week. They talked about how China's presence here does seem much more muted, at least publicly facing, than in previous years. But that's not necessarily the case when it comes to behind the scenes. They also talked about the private engagement between private companies and other international firms here still being quite active, and a lot of sort of proactive outreach going on there. The other element that sources have been talking to me about is this idea of a contingent at Davos this year who are essentially trying to recalibrate their expectations of how to do business with China. So they are relearning how it is that they can engage with China, understanding they cannot just ignore China, and instead trying to work out what does it mean to do business with the country and with businesses there, given the slowing economy and all of these geopolitical risks. And when it comes to some of those behind the scenes and soft power efforts, a big part of Davos is, of course, what happens at the end of the day and those evening parties. I can say one of the most sort of best attended, at least that I've seen, was this evening reception hosted by the northern Chinese city of Tianjin, where there were hundreds of delegates there enjoying particularly this very wide spread of local Chinese delicacies, including things like jianbing, egg stuffed pancakes, and jiajiangmen noodles. Probably one of the best meals that some delegates are saying that they ate all of this week. So on some fronts, perhaps we can see that China still is quite a presence here, albeit somewhat more understated, albeit somewhat more lower key, but still visible and enjoyed by some.
All right, that is Rebecca Cheung Wilkins from Davos. Plenty more ahead here on The China Show. This is Bloomberg.
Welcome back. Lithium stocks are not as lit as they once were, and might be down to the story today and really underscores the challenges the industry has found itself in. Tianqi Lithium issuing this profit warning, also giving some guidance on an impairment. Let's bring in Martin Ritchie, our commodities reporter, to take us through what is going on here. And what did the company say, Martin?
Yeah, that's right. Tianqi Lithium is one of China's two big lithium companies. It has investments not only in China, but in Australia and in Chile and around the world. And it said last night it's going to make a loss for last year of up to 8.2 billion yuan, which is $1.1 million. The lithium market has been terrible the past year or two. There's been too much supply coming from a whole wave of new projects that appeared around the world, and you've seen the EV revolution sort of stall a little bit, and that's just left the market saddled with too much supply. So along with that profit warning, Tianqi also said it's not going to go ahead with the second part of its expansion to a flagship investment in Australia. This is just adding to, I guess, all the announcements we've seen over the past 6 months, 1 year, of lithium companies sort of pulling back, stopping their expansions, trying to get the market more aligned with demand.
Well, Martin, how significant is that they're going to be halting that expansion in Australia?
Well, I'll just give you one little nugget about that plant. When Premier Li Qiang of China went to Australia last year on one of his first major overseas visits, he visited that plant. It's in Kwinana in Western Australia. So it is a very significant investment for China in Australia. They do have a plant there already. The Tianqi invested in mines and a refinery there, so it is running, but they're now cutting off that second stage of expansion, doubling the capacity to 48,000, and yeah, it's a major step given the significance for that plant, both in the lithium market and for Chinese investment in Australia.
Martin, thank you so much. Martin Ritchie there in Shanghai for us, our commodities reporter, on really what is, I think, at the very core of it, an earnings story and the warning coming through there. And I mean, it will be a story that will continue to dominate through the holidays coming up next week. Now, speaking of numbers here, casino stocks, as you can see, a little bit to the upside right now. Gaming revenue up 10% year on year. That's for fourth quarter. Of course, we look forward, and we're really looking ahead to what details and what sort of volumes of visitors and spend we see as we make our way, as I mentioned, through the upcoming holidays. Now, speaking of earnings, a couple of names to get you through here. So Chalco, we're looking at prelim net income on the up. Shares are up 1.5%. Galaxy Securities is up about 2% right now. That's also an earnings story, which came in above consensus. Joe Gray Liquor is actually leading the declines across some of the liquor makers here on the back also of some profit warnings. They're out of the company specifically. And Shenhua Energy is also an earnings story, up a little bit, although the net income coming in, at least as far as the guidance is concerned, full year net income, negative 1.4 to negative 6.1%. Okay, other things to track here. And by the way, while we look at the benchmarks too, I think we have some time here. Can we talk about the BOJ too on the back of this too? Because that is one that is coming up. I think just to recap some of the inflation numbers which came out of Japan early on, underscoring not just a hike today, but possibly they might need to think about the future. Anyway, as far as China goes, CSI 300 is flat today. We're still flat for the week. We are on track, though, for a weekly gain as far as the Hang Seng goes. And, yeah, I mean, Steve, apart from the China story, the BOJ, I think, is one.
Yeah, I'll guarantee you the BOJ is thinking about the future. Definitely. Just how dovish a future is it going to be?
And how clear do they...
Right. Still ahead on the China show. Eastspring Investments and ING Bank join us as we await that likely rate hike. Could it be 25 basis points? It would be the biggest in 18 years. First hike since July as well. We'll have a lot more on the way in the next hour. You're watching the BOJ in Tokyo and the China show.
Welcome back. You're watching the China show, just entering the second hour of programming. And as you can see, we are really heading into the weekend on fairly solid footing, up 1%, still flirting with the 20,000 level. We haven't managed to close above that sustainably, I think is the operative word there, over the last couple of weeks or so. We'll see if today is the day, and of course, what next week brings. All that being said, though, when you look across these markets, it's really been a very good week for risk assets, which we'll get to in a moment. The big story coming through, of course, this hour, possibly, is a BOJ decision. So everything from what they do with the policy rate, how much they do with the policy rate, if they move in the policy rate, what the forecasts look like, and then all roads will lead to the guidance and what they say at the press briefing in the afternoon, Steve.
Yeah, that's right. And this was a different one than most BOJ meetings because they give their quarterly economic outlook as well. And if you look at the timetable about when we're expecting that, it's usually later when they do if there's some sort of movement. As you can see here, if there's some sort of cut or hike and there's an economic forecast, it comes after noon. Or if there's a hold, like we've seen, it's before noon.
I mean, you probably notice.
Yes, I've stood outside the BOJ.
Waiting for this to happen, too.
Yes.
And anecdotally, I was told that the reason it tends to take longer when there's a change in policy is down to the translation of the statement from Japanese to English. And also the fact that, and I think for our viewers, you can verify this yourselves. I could be mistaken, they might have changed it, but I think the BOJ still scans the actual statement and then puts the actual document on their website. So it's not as if you could search through. So it's very difficult for us to parse, basically.
Japan, in large part, still uses fax machines, and they're analog, right?
There we go.
In a digital economy. But again, also, it depends on how unanimous or non-unanimous the rate decisions are. So they're just clarifying that's sort of the verbiage, if you will.
And it's good to have a consensus, of course, as you put that message out to the markets as well. In either way, I mean, we are almost fully priced as far as a move today is concerned, which would be, I think, consensus is for a 25 basis point hike. And as Steve was pointing out, if they do move by that much, that would be the biggest increment in about 18 years there out of the BOJ. It's as we were pointing out, we are tracking the move up on Wall Street, a new record, of course, on the S&P. I think we're up every single day this week on the Asia Pacific. I think the last time we actually had let me just call it a royal flush, Monday to Friday, you had to go back to, well, effectively late December, which is not that too long ago, but liquidity tends to be thin at that point in time. In any case, we're up 8 out of the last 9 days, and there we go. We are actually on track to retest the highs that we hit back in early December. And, you know, in the next couple of days, we could actually see global stocks actually hit a fresh record high. Okay, let's talk about, at these levels, at these valuations, what do you do? Christina Woon is with us right now, portfolio manager at Eastspring Investments. Christina, good morning, and thank you for taking the time to join us. Apart from
Hi, good morning. Thank you.
Some weak spots across EMs, India, China. Largely speaking, equities have done well this year. How have your funds done so far, year to date?
Year to date, we're holding up all right. As you've rightly mentioned, it's been quite a volatile start to the year. You've got quite a number of events that have happened. Trump's inauguration this week, expectations when it comes to China as well. But the way we've approached things is balance across the portfolio, and so far that's working out quite all right for us.
Well, Christina, of course, with the S&P 500 trading around record highs, we've had a Trump bump. How does Asia play the Trump bump when there's a lot of possible trade friction on the horizon?
Yeah, and that's a really good point and extremely topical at this juncture, because everyone is watching what will come out of Trump's new term. What we've seen so far this week, and it's a bit early to make really definitive calls, is the fact that he seems to be a bit more measured in terms of his approach towards trade relations with China. And of course, that could change and evolve as the months play out. But for now, that's sort of encouraging. If things aren't as harsh as people are expecting, perhaps the impact wouldn't be as great across the region.
I think, also to your point there, Christina, it might be an opportune time to just remain defensive. And I think income, which you manage as a strategy, is doing quite well. Talk us through what goes into sort of an income portfolio right now, and do you expect this sort of strategy to continue to fare better than others? Let's put it that way.
Sure. I mean, our base premise here is the fact that we expect volatility to persist. And as we've sort of discussed so far with the different changes in the US and in China, that is a reasonable base premise to work on. When it comes to income stocks, it's quite simple, really. It's the fact that you are getting, returns earlier, and you're not taking that longer dated risk to reward. You get the dividends ahead of time, and that's something that does calibrate or manage the investment thesis with a bit of defensiveness as well. Within Asia specifically, I think what's also really helping is the fact that there's an ongoing rhetoric of increasing shareholder returns and better corporate governance across companies. And so income stocks actually benefit quite well from that. And you see this play out in several markets across Asia as well. So that's why we do see that in this environment of volatility, the defensiveness that income stocks give you is quite attractive.
Christina, were you encouraged, or maybe that's not the right word, but what do you make of the big press conference we got out of Beijing yesterday, essentially with the CSRC head and also the finance ministry and PBOC, essentially trying to boost up the A-share market and making longer-term returns and investment into the A-share markets more sustainable? I mean, is that a way to prevent a Trump slump, I guess, or is it really going to work long-term to attract, institutional money into A-share markets? What's your outlook there?
Well, I think that the key message that we've gotten from that is really that market stability is a priority for the government. I mean, the main thing that is notable is the fact that if you're attracting longer-term investments into the A-share market and people who are holding on to these investments for a much longer time, then perhaps you could see some stability there. That's something that we would find encouraging as well, because if we took a step back and look at what's happening with China, the confidence needs to be restored, and hopefully these acts and these moves from the government will be able to restore some of that as well, and then perhaps bring back more interest to the market.
Yeah, Christina, I think just to build on that, and maybe this also touches on the point that you've already made, a two-part question here on China is, one is the announcements yesterday, well, the notion that improves the potential upside for dividend and income stocks in China, and I'm wondering if you agree with that. And point number two I want to ask you is, how have you managed your overall China exposure within your portfolio?
Sure. I mean, typically within the A-share market, it's not necessarily known as, or not typically known as a yieldy market, but you do find opportunities there as well. The other aspect when it comes to Chinese stocks is also, even if payouts are low at this point, the ongoing rhetoric there of having companies think a bit more about capital allocation and shareholder return also means that even if payouts are low at this point, there is a trajectory for things to go up a bit more. And then the way we look at China for our portfolios, bringing back to the point that I made earlier, is really about balance. So if we assume that there is going to be volatility, people are scrutinizing every word that comes out of China, then there will be balance then becomes quite important. So having a bit of stodge in the portfolio with perhaps cash generative companies that are a bit more stable, but also ensuring that the portfolio participates in the beta in the market. So for example, having companies that benefit from replacement cycles or trade-in subsidies, for example. That's sort of how we would try to balance out the exposure in China.
So what would you be waiting for from March, the National People's Congress, that would give a boost to confidence, a boost to markets, and essentially put a floor on what we've seen in the property sector? Again, those officials from the Finance Ministry, the Securities Regulator, and the PBOC were there yesterday to kind of boost the stock market. But is there something else macro that you would really latch onto that is needed? I mean, I would guess fiscal stimulus.
I think you're absolutely right. Everyone, I would say, out in the market is really looking at the size and materiality of any fiscal stimulus. But the one thing that I would caveat with that is with all the moves and perhaps false starts and disappointments of the past couple of years when it comes to investing in China, what I think people are coming around to a bit more is that it's around managing expectations that it's not going to be, a shot in the arm or a big bang stimulus. And going back to that point about stability, any moves that we would see come out of March would probably be along the lines of a longer-term stability in the market rather than big bang stimulus. And that's sort of where we are landing. But again, exactly right. It is the size of fiscal stimulus that I think people have their eyes on.
Yep, Christina, I'm not sure if you guys are part of this B of A fund manager survey. I assume you guys would be. But in any case, of course, the latest one actually, and it's quite salient in terms of the timing, because one of the takeaways there, which I think you just underscored, is that the big if is if China somehow manages to beat expectations in growth this year, which could be a game changer for many strategies. And I'm wondering if and when we start to see really the Chinese economy start to respond, how do you think that affects portfolio construction from your perspective? Like, what would you be looking to buy in that scenario?
I think that would be one of the key risks of this year, as we sort of touched on in our discussion as well. Expectations are low. Investors are skeptical. They'd rather see proof of the pudding first before making big bets. I think if we do see anything meaningful come out of March, people will have to adjust their positioning within there, which is why I think, again, going back to what I mentioned earlier, you do want to ensure that you're not caught on the wrong side of that. While you are defensive in your portfolios or your allocations to China, you also have to ensure that there are parts of your portfolio or within China, your exposure to China, that do allow you to participate in any upside that might come.
Christina, just maybe to table China for now. What about India? The market's pulled back since late last year, arguably still expensive. What's your take on that market?
Well, we're quite positive on the market over the longer term. I think the key thing that we have to watch, though, as with many markets, but particularly with India, is the expectations around the market. it's had a good run, as you've also rightly noted, and investors are really looking at earnings delivery, maybe not just earnings, but also on the revenue side. Growth needs to continue within this market in order for valuations to stay where they are, and that's sort of what we're looking at as well. There are certainly opportunities in that market, not just short term, but also long term, but it's how we calibrate those expectations in that market with portfolio construction.
How about Korea, Christina? If the political uncertainty continues, is this something to hold off from investing in right now, or opportunities from a depressed political environment?
I mean, you're absolutely right. It's been quite a tumultuous year for Korea as well. You know, we started off with a lot of excitement with value up, and then ending off the year with political uncertainty as well. But there are definitely opportunities there. While value up may have faded a little into the background, and people have called into question the effectiveness of that, there actually are a lot of companies within Korea that you can find who are, who have actually rolled out shareholder return policies and improved corporate governance ahead of all this value up chatter. So these are where I think, right now these companies are still committed to delivering on these policies that they've rolled out, and that's the opportunity set for us.
All right, Christina, great to have you on the show. Happy New Year to you coming up here on the Chinese New Year, the Lunar New Year. Christina Woon joining us there. All right, we have some breaking news coming across the Bloomberg terminal. Donald Trump and Xi Jinping, according to the U.S., has had a good and friendly conversation together. We don't have any other details other than that. Was it a video conference, a phone call on the hotline from the White House to Zhongnanhai? We simply don't know right now, Dave, but an interesting development that they just spoke last weekend, according to U.S. sources, and now they're speaking again.
Let me just, actually, I'm trying to find more details on that, actually. Yeah, so the comments are, I think, and we're going to get more details, I think Donald Trump was describing that chat that they had late last week.
Oh, so this
in
is
an
not
interview he was doing at Fox, yes.
Okay. That was not
Otherwise, that
clear.
would have been better, actually.
That would have been better if they had
chatted
another
again.
conversation.
Yeah. Anyway, there we go. This is file video.
That's 6 years ago.
Yeah. There we go. How times have changed, and something hopefully we'll see in the sooner before later. Plenty more ahead. This is Bloomberg. Oh, here we go.
Context is everything.
Context is everything. Context is key. Dollar China down. Some strength coming through in the Chinese currency.
Look at that chart.
We can tie that now directly to this comment that came through out of the U.S. president that he would rather not have to use tariffs on China from this Fox interview that the U.S. president is doing. And again, I think big picture context, right? We keep talking about how in many ways what concessions on trade China can do. What can they import to appease or to avoid the worst case scenario for tariffs? We had that conversation earlier with Morgan Stanley's Robin Xing. When you look at the trade relationship, there isn't a lot that China can do as far as purchases are concerned to move the needle on the surplus. Might this mean, and this underscores the more salient and crucial point, is tariffs are used in a larger context on other issues, of course, that the U.S. president perhaps wants to discuss with China. Steve, you want to chime in?
I'm just trying to get the context of these comments from Donald Trump. He says, we have one very big power over China, and that's tariffs, and they don't want them. And I'd rather not have to use it. But it's a tremendous power over China.
It's not just Chinese assets that are rallying right now. We're looking at proxies right now rallying as well. We're looking at the Aussie. We're looking at the Kiwi also reversing some of the early weakness. We can get that up, please, if we can. Chinese equities are up 2%. On the HS Tech Index. I've yet to see other proxies as well, but I would imagine this move is now fairly cross-asset.
Look at
there
that.
we go. There's a rally now taking place. Was taking place, I should note. We were a little bit higher, but now we're now up above the 20,000 level on the HSI, and there we go. Steve.
So this is really building upon, of course, day one of the Trump administration when he did not single out China, and then that kind of enthusiasm that, oh, maybe he's going to take a much more measured approach, but that sort of petered out, as he mentioned the next day, 10% tariffs because of border issues and fentanyl. And again, though, the talk and the chatter in the market was tariffs are inevitable. But this is kind of giving an indication that He is talking to Xi Jinping. They are talking about tariffs, even though he said he didn't talk a lot about tariffs.
Yeah.
Oh, I know they did. Of course they did. It's the key point, right? So it looks as though just one line saying he'd rather not have to use it, but it's a great power over China. So that's giving a little bit of optimism that this is negotiable.
Yeah, it's flexible. What can China give to be able to get to that scenario, I think, is the question we were putting earlier on to Robin Xing. Markets are listening very, very quickly. We'll be on top of the story, more details once we get them as well. The other thing that came out of President Trump overnight, as he spoke, of course, to global leaders and executives over in Davos, Switzerland, he wants cheaper oil. In fact, on that very story, he called for lower prices in that virtual address, as we were pointing out in Davos. Let's bring in our oil and shipping reporter, Waylon Sun, to talk us through this. So what did the U.S. president exactly say here?
So overnight, what we hear from him, speaking to Davos leaders over there, is that he wants the OPEC, the oil-producing nations, to really bring down the price of oil so that he can put additional pressure on Russia to stop its war in Ukraine.
Well, Waylon, what's the significance of this in relation to, of course, OPEC Plus's plans to resume suspended output?
Right, it's kind of an interesting situation if you think about it. OPEC has been holding back production so that oil prices can remain elevated. And they have thought about future plans to resume those production probably in April. So Trump's, if you could say, an intervention at this point sort of brings that timeline, throw it into a disarray, right? And what do we think about the U.S. production, domestic oil production too? If Trump wants to have that oil price weaker, this could also force U.S. producers, give them a different set of thoughts and reasons to balance their production, supply, and demand over there in the domestic market. So it really throws a lot of throws new questions into this production timeline that we have already seen since end of last year. And it really begs the question of how this will actually work out in practice. This would definitely be something that we want to see in the days and weeks to come.
Well, the other part to this, really the same equation here, is when you look at overall demand for oil has really been weak. How do we balance those two things?
Right, and that's a really good point, David, because when we look at the oil prices as they are now, it seems like it's hitting for the first weekly decline this year, but we have to bear in mind that oil prices have risen so much this year on the back of sanctions on Russia and Iran that the outgoing Biden administration has put in place before they handed over to Trump, right? And that sort of shook up the market, but the overall decline in oil prices was kind of telegraphed by many oil analysts. We saw Brent closing in 2024 at around $74 to $75 per barrel. It's still now up at around $78 per barrel, despite this decline. So there is still a little bit of room, probably, for oil prices to drop, and that's because we have heard quite a while China demand for oil has been weakening. There is this broader transition to electric vehicles and greener fuels. So that sort of depresses oil demand, and right. That is really the broader picture here.
Waylon, thank you so much. Waylon Sun there, our oil and shipping reporter in Singapore for us. More on the breaking news coming through in the last few minutes or so, and some of the comments coming through out of Donald Trump. And really one stood out. I'll get to the other lines in just a moment here. That if he had the choice, he would rather not have to use tariffs on China, strengthen the Chinese currency. We're also seeing some strength in proxies, like the Aussie dollar, like the Kiwi dollar. It's not just that. Copper is also moving to the upside. U.S. futures are also pushing higher, coming up on your screens very, very shortly. Long story short, markets are continuing, and we don't know if rightly so eventually, but they're continuing to price out worst-case scenarios as it pertains to tariffs. And as you can see, this is a really strong cross-asset move across many global assets so far here, Steve.
Yeah, that's right. I mean, some of these comments are coming through. Trump says he will reach out to North Korea's Kim. Remember, he had those two summits as well as a meeting at the Panmunjom East Village at the border. He engaged.
Yeah, it was in Vietnam. There was a Singapore
He was
summit.
in Singapore. He was in Vietnam.
Yes.
Did he not go to Korea as well?
You know what? I think he might have actually. No. The Korea, I think, wasn't that a South and North Korean summit right at the border? Could be mistaken.
Could be mistaken.
Yeah.
It's a long time ago. It was only 5 years ago.
Well, I can't even remember what I did and ate last night. Plenty more ahead. This is The China Show. Right, welcome back. You're watching The China Show. We're recapping the breaking news. Okay, here we go. The news gods are raining down upon us right now. So according to Donald Trump and his Fox News interview, he's moving markets with these comments that he would rather not have to use these tariffs on China. Chinese assets, Chinese proxies, risk assets are all responding to that. We're coming off highs a little bit, though, across the edge. Aussie dollar I can see coming off a little bit, but visually, of course, U.S. futures are coming up. And also copper on your screens are trading at higher levels than they were a few minutes back. Plenty more ahead. This is Bloomberg. Welcome back. You're watching The China Show. Here is something I never thought I would say, but I would imagine it would not be out of the realm of imagination if officials in Beijing are actually tuned into Fox News right now on the back of these comments coming out of the U.S. president, which actually moved the needle on markets significantly. And it actually might move the needle, depends on the context and what he meant, and really how the question was phrased, what it means for future negotiations on this. But the point being, if you ask the U.S. president, he would rather not actually have to resort to tariffs on China among I guess this is a multi-pronged negotiation, which doesn't include just trade. Because if it's only trade, as Steve and I were just talking about earlier on, there's very little as far as purchases that China can do to really close that trade gap. And I think that was the point that Morgan Stanley was making.
I think this comment to Fox News about his conversations with Xi Jinping sheds light on the nature of their conversation and the weight that conversation had on that day one announcement of executive orders, including tariffs. So he's essentially adding more fuel to the notion that Trump is willing to negotiate on tariffs. It could be protracted and prolonged process, and that he is going to perhaps even have more discussions with Xi Jinping on the efficacy of it and how they can balance the punitive side of tariffs versus the benefit of engagement with China. So,
yeah, I think you made a good point earlier on that the phase one agreement, we don't really know how that would have eventually panned out because we had a pandemic. And I think the conversation was, should we resort back to phase one and see how that goes from here on? And I think the point that Robin Xing out of Morgan Stanley was making earlier on was the world has changed substantially since then. You know, supply chains have been rejigged, and
well, Robin Xing was saying that the phase one trade deal was probably too ambitious, but in hindsight, it's too ambitious because the pandemic happened, the spy balloon incident happened, sentiment towards China really deteriorated, and the mood in Congress deteriorated quite considerably over those last 6 years or so. So, now this, I find this headline very interesting. Trump will reach out to North Korea's Kim Jong-un. We just talked about that before the break. Obviously, he had the Trump-Kim summit on Sentosa Island in Singapore, followed by the one in Hanoi at the Sofitel there, which Trump, by the way, walked out on Kim Jong-un. I was at both of those.
You covered both those, right?
I covered both of those. I was not at Panmunjom, but he did also meet Kim Jong-un at the Truce Village, the border, becoming the first American president to step into North Korea, albeit briefly. So what would be the fourth meeting? What would that look like if that actually happens? Yeah,
we are, I think, in many ways picking up where we left off. Right before the pandemic actually hit, which was really, of course, when Trump was first in the White House. In fact, if you guys need more context on what was said and how he said it, here you go.
We have one very big power over China, and that's tariffs. And they don't want them, and I'd rather not have to use it. But it's a tremendous power over China.
Bill Ferries, our senior editor, is with us in Singapore. Bill, I got to say, as a headline itself, quite powerful and potent, and you see that really across asset reaction, across global markets right now. How do we read into this?
Yeah, I think it's almost impossible to read too much. I mean, listen, it's been not quite a week yet. I mean, of people expecting a wall of tariffs to come down after President Trump took the oath of office. We haven't seen that, and when he has talked about tariffs, it's been about in regards to Mexico, Canada, and places like Russia. So in that sense, there's been less focus from this administration on China so far, but it also, you could read that 1,000 different ways. One way to read it is he's keeping a little bit of uncertainty out there. It gives him some negotiating room when it comes to working with China on that phase 1 trade deal that you mentioned earlier and next steps. On the other hand, he does not have arguably his most important economic advisor in office yet, and that's Treasury Secretary Scott Bessent. Could get confirmed this weekend, but he's not there. And if you institute tariffs and there's a big market reaction, you want to have your Treasury Secretary sitting right there to help you figure out how to calm those markets and deal with the response. So markets responding to these comments today, and it's certainly been easier on China than I think some people expected, but it's hard to know whether that means anything for next week or next month.
That's true.
Well, Bill, does it indicate the whipsaw nature of how the markets respond to tariffs, whether they are going to be phased in or all on day one or not on day one or selective? Does that basically indicate that the power of the tariffs and the power of that threat?
Yeah, I think it does. I mean, you heard President Trump there saying it's big leverage, and it certainly is. I mean, he talked at one point about putting tariffs as high as 60% on Chinese goods. So, if you're talking about a range that starts low, maybe 10% or less, and then builds up potentially somewhere at 60% for some products, that's a huge amount of space to work with and a huge amount of leverage. I think President Trump is watching closely how markets react. That's one metric he cares about deeply. So I would suspect he's probably holding off as perhaps his aides kind of try to figure out how this would come into play. But it also it's a good negotiating tactic, I think, from his point of view.
Yeah, I mean, the other thing he pointed out in that address at Davos was he wanted lower rates. I mean, many economists would tell you if you wanted lower rates, then don't push through with the tariffs, right, Bill? Bill, well, we don't know exactly, and you make a very good point. Well, we don't know exactly how this story plays out next week, even tomorrow or next month. I think in one sense, it reminds us that, number one, markets have been pricing for worst-case scenarios, and they're pricing that out slightly right now. It does give us, though, a clue and a glimpse as far as his intentions go and what tariffs really mean, not as an end goal, but really as a negotiating tactic.
Yeah, absolutely. I think he sees that. Listen, in his first term, Donald Trump looked at the countries that had the biggest trade deficits with the U.S., and he went after them. It was included, South Korea, Japan, Germany, the EU as a whole, but China, of course, at the top of that list. A lot of those countries are still the same. I think he's talked about the power of tariffs as a negotiating tool, and he'd like to see countries making a response ahead of his decision to implement tariffs or not. And you've actually seen that. You see countries in Asia and you see countries in Europe talking about maybe they're going to start buying more American products, whether it's LNG gas or other types of goods. So it has an impact. He sees that, and he's going to probably look for some results, and then before he makes the decision about whether to go forward and how strong those tariffs come into play.
Bill, thank you so much. Bill Ferries there, our senior editor, who we thank you for rushing to the camera. Give us more context, key context here on this breaking news. Right, let's talk about New World Development. We have a story out today which really encapsulates what really this eventful week has really been. Right side of your screens is the absolute collapse in market value of the market cap itself. 93% from the 18 billion peak in 2019. Left side is the collapse we're seeing in the bond price. down about a third, really, call it even, over the last month or so in dollar bonds. We'll bring our team in, Patrick Wong and Francis Chan, co-authors of a report right now to Bloomberg Intelligence, to talk us through this. And, Steve, I'll bring you in here because you actually, Steve, made a very good observation here with how Patrick actually described the situation of New World, Steve.
So let's bring in Patrick. Patrick, how do you describe what is happening with New World? They've had a roller coaster. They've had two different CEOs in the last couple of months. There's a succession issue here. There's an over-leverage issue here. There is a China property market collapse at issue. How do you assess the financial situation they're in right now?
Yeah, I think the market looks like really crazy recently with the equity holders, bond holders getting lots of concerns right now because in terms of the news flow, I think the company didn't come out to say too much until recently. We received, like yesterday, they come out to say about the progress of bank refinancing, which is better. But the challenge right now is more about the asset disposal, which didn't make too much progress. And basically, I think we look for lots of support from the parent company, not much support from the state-owned developers. So that is the challenge right now.
But Patrick, what kind of leverage do they have when their bonds are collapsing, the stock price is collapsing, there is a crisis of confidence, and they have to sell like K11 art project or building, and they're basically, the potential suitors, like I believe a subsidiary of a Chinese conglomerate, is basically lowballing them.
Yes, the challenge right now, I think, is in terms of the long-core asset sales or whatever, shopping mall or the others. I think the challenge is the interest rate coming down a bit, but recently we see the treasury yield also up close to 5% at some point. So it makes the investment market being more challenging for the developer to sell any sizable asset at this point. So, and then office rents also coming down a lot, so it also makes them difficult to sell office. So that is right now the situation for New World.
Francis, let me bring you in to discuss the banking angle to this. Just help us understand what the exposure is of Hong Kong banks here.
Well, as of June 2024, New World had 126 billion Hong Kong dollars of bank loans, according to the disclosure. And we estimate that those from Hong Kong banks would be around 110 based on the denominated currencies, Hong Kong dollars, US dollars alike. And that would be equivalent to about 7% of the Hong Kong property development and investment loans disclosed by Hong Kong Monetary Authority, or about 1% of the total loan book, which is about 10 trillion in Hong Kong. If you look at those numbers and considering this is still the fourth largest property conglomerate in Hong Kong by assets with a lot of quality assets, you don't expect all the amount to be wiped out. And I would say in near term, at least, those exposure could be manageable by banks. But at the same time, I just want to highlight, according to our news colleagues, citing people with knowledge, they are talking about they're planning to refinance 58 billion Hong Kong dollars of the debt, which is a good sign. But more properties could be pledged, so those could be, a risk for the banks if the firm will be running out of quality collateral in future.
Yeah, well, Francis, the overall exposure the banks have to the Hong Kong property sector, is this an anomaly? Is New World an anomaly? I'm sitting next to Patrick, but I'll quote him in his report. He said, New World's situation is the worst for any major developer in Hong Kong since the Asian financial crisis. Well, if New World is or isn't an anomaly, other developers here in Hong Kong, even though they're not as leveraged as New World, with 92% debt to equity ratio, are there other possible banks that could fall into the same kind of trap? Excuse me, property developers, not banks.
Yeah. Well, Patrick, feel free to jump in if you can, make more comments on this topic. I would say it's also about the valuations New World has put for its properties on the books in the balance sheet. And I just called Patrick here, and Patrick, please feel free to add your comments. It would be about the valuations that could be based on a pretty low cap rate, and that may add to a potential devaluation of their assets on the books, and that may be a major problem. The leverage ratio you're seeing now could go higher, and Patrick published a very good report like 2 days ago. So pass on to Patrick.
Yeah, Patrick, if you could comment on that Francis just mentioned, and if I could also ask you, we've seen developers come back from something worse than this. Is there, in terms of the project pipeline and the outlook for demand for property, Patrick, do you see a path forward here for New World?
Yeah, I think it now come to a situation that as I said, right, the mortgage rate is coming down, and then the treasury yield is still up a bit versus like a couple of months ago. So it depends on the interest rate outlook quite a lot. And then fundamentally, I think that is they have some good quality assets like those like K11 you mentioned in Cheung. So if they can really sell some of them, right, or it may be even a better choice than patch to the banks, right? Because I think the bondholders or equity holders are also getting concerned about the patching lots of assets to the banks. So that is the situation right now.
All right, Patrick. Bloomberg intelligence analysts Francis Chan and Patrick Wong joining us here to talk about New World development and their issues there. As we await the BOJ decision, could come any time right now. ING Bank will be with us next to explain why they expect a hike and what policymakers should be watching for potential detours on the road to normalization. Minju Kang coming up next. This is Bloomberg. And welcome back. You're looking at me, but you're soon going to be looking at the BOJ in Tokyo. I've stood outside that building for a long time. Dave, that's not coming up yet. But of course, we are awaiting the BOJ decision, widely expected and priced into the market of a rate hike, perhaps 25 basis point. But really, I think the market, Dave, is going to be focusing in on the guidance coming from the governor, Ueda. Strategic ambiguity, perhaps, as well, to avoid a sharp spike in the yen. So we'll have to see how that plays in. Let's bring in, David, do you want to bring her in, Minju Kang?
Why not? Minju, thank you so much for joining us. She's senior economist at ING. As we await, Minju, this decision, it seems that consensus is fairly clear anyway. So let's get it out of the way. Do you think they're going to hike today?
I think so. If not, then, the market will react to, the non-consensus call very badly, I guess. But already, this rate hike was very well telegraphed, I believe, because, not only just the governor Ueda, but also, deputy governor also, said in a couple of weeks that, they are very ready to rate hike. And after that, they were very concerning about, more closely watching what the Trump administration's policy will be like. And for the couple of days, actually, the Trump's trade policy is mostly in line with the market expectation. And there's no particular bad news for the Japanese economy so far. So probably, the BOJ will be more supportive to deliver a 25 basis point hike.
But what kind of tone should or will Governor Ueda give? Will he be cautious and be a dovish hike, or will he see that inflationary data and maybe the risks abroad are abating? Maybe he can be a little bit more hawkish. What do you think?
Well, we believe that, he continued to, committing that, the BOJ will deliver more hikes in the future if the economy recover in line with the the BOJ's projection. However, I think he probably would like to avoid to deliver more clear timing of the next hike or the even terminal rate of this rate hike cycle. Because yes, you already said that probably they'd like to avoid market volatility they had experienced in last August and July time.
Minju, this goes into it. I think for one, it's been a while, a generation almost, since we've talked about the BOJ hiking rates. And it wasn't too long ago that, to your point, they shook markets because there was a communication gap between what they wanted to do, what they wanted to say, and what they wanted to guide. And we had that massive move in the markets. How would you currently describe their ability to communicate their guidance?
Actually, today the BOJ will release their quarterly outlook report, and by showing them the updated inflation outlook, we believe that they're going to upgrade a little bit. So throughout the forecast period, we expect that they are going to upgrade the inflation outlook to above 2%. So which gives more indirectly that they are going to give more rate hikes in near future, because this inflation target of 2% is more likely sustained for the next 2-3 fiscal years.
What? Okay, sorry, Minju, we're just getting some headlines coming across.
Actually, false alarm.
False alarm. Never mind. Sorry, I got paralyzed by the Bloomberg terminal. Let me put a scenario to you. Let's say, for example, they hike today by 25 basis points, right? Then in the spring, you get the annual wage negotiations, the shunto. The wage growth is better than expected. We already got that CPI print better than expected. What does that, A, mean for the yen? Because it's been languishing around 156. It has now strengthened a little bit to 155. And does that really, if all those things come in line, a little bit more of a hawkish tone from Governor Ueda, does that mean April and July rate hikes are going to be starting to bake in?
Yeah, actually, very surprisingly that the market hasn't, priced in another rate hike until July or September time. However, we believe that, we already hear from the local news media that next year's junto should be reached to almost, same level, a strong level as, the last year's wage agreement. And if the market, then probably market, expectations slowly change to another additional hike for either for April, the May time. But also we believe that the inflation. Today we got the headline inflation shoot up to 3.6%. However, this is more because of the government energy subsidy program and also some fresh food price hiking. However, if we see the service prices steadily rising, then that's probably more important gauge for the BOJ to deliver more rate hikes. So then, market will start to price in, more seriously about, rate hike faster than what they have expected now. And also, but however, for the JPY movement, we believe that not only just BOJ's action, but also Fed's move and also the Trump's trade policy and fiscal policy will play a lot on, this going to be more important determinant of the BOJ and also the yen level.
Minju, to your last point, is there any potential catalyst that is visible over the next, let's call it 12 months, that manages to shake the exchange rate out of this current range of 150 to 160?
Actually, ING believes that the strong global dollar movement will eventually come back. Then, even though the BOJ, deliberately to, we think that, to 1% by the end of this year. However, by the end of this year, probably the JPY should, still, stay around more high 155 level. And this is our, view on our JPY.
All right, Minju Kang, thanks for rolling with the punches with us here on Bloomberg Television and the China Show as we await that news from Tokyo and the Bank of Japan. Minju Kang, senior economist at ING Bank. And you can also turn to your Bloomberg for more on this. Go to TLive Go to get commentary and analysis from Bloomberg's expert editors.
Yeah, there we go. So from one potential breaking news to one that has really given us a lot to talk about this hour, the interview of President Trump with Fox News has given us a lot of headlines to chew on. And I'll just make it very, very simple here, that he would rather, if he had a choice, perhaps not use tariffs on China if it was completely a decision purely on that as well. And those comments have been enough to move markets to the current levels right now. S&P futures reversed their early weakness, and the strength coming through in Chinese assets and Chinese proxies as we make our way into the weekend. All right, that's it from us here on the China Show. Happy weekend, Steve. Happy weekend to all of you. We'll see you all on Monday. Sherry On is coming up next.